Hi, everyone. Thanks for joining and welcome back to Wall Street Silver. Our guest today is our good friend, Peter Boockvar. He is the Chief Investment Officer with the Bleakley Financial Group. Peter, welcome back.
Thanks for having me.
Yeah, it's always a pleasure having you on. What's going on in the world is pretty crazy. We're in the middle of a global crisis, energy crisis, and an ongoing war. And you see the U.S. dominance being challenged. How dire is the situation going into 2023?
Well, it's from an economic perspective, it's obviously very difficult. Central banks in raising interest rates is sort of tightening the noose around a global economy and markets that aren't used to that. They're used to very low interest rates and cheap money, and that has created a lot of borrowing, high debt levels, and excessive valuations that, of course, is now readjusting. But it takes time to adjust to a new inflationary slash interest rate environment that's much higher than what we've seen. And it's not something that happens overnight. So as we look towards next year, I still think that we have more of that adjustment ahead of us. On the geopolitical stance, well, trying to figure out what Putin is going to do is very difficult. Trying to figure out what China is going to do, both with respect to their COVID approach and Taiwan, is also very difficult to gauge. On the first part, I do think that China is using Hong Kong as sort of a test tube case for how to further open up. They've made a lot of good moves in Hong Kong of getting rid of the hotel quarantine, even though they need to tweak it some more. And also finally allowing tours again to go to Macau for the first time since COVID. So maybe this is sort of a precursor for a broader reopening in the first quarter of next year. But the geopolitical stuff is always, we can assign probabilities to certain events, right. But past that, it's a coin toss.
Now, do you think, Peter, the Fed is ultimately trapped? Because usually what they're doing is reactionary. They see inflation data numbers come in and then they react. What is your personal opinion? Do you believe they're trapped?
They're absolutely trapped, but that's by nature of the institution, is because when you have bureaucrats that are setting the cost of money rather than the market, the bureaucrats are going to react in a much more delayed fashion than markets. Markets get things wrong sometimes, but they quickly readjust, or they're quickly changing their opinions on a daily basis, where central banks just don't do that. So that always implies that they're most of the time going to get things wrong. And the problem with, again, everyone gets things wrong, but they stay wrong. They don't quickly adjust. And that's why they always end up trapping themselves. They trap themselves on the easing side, and they certainly trap themselves now with the tightening side.
Now, looking at England, like a lot of people have been talking about them this week, to avoid pension funds blowing up this week, Bank of England intervened and ultimately pivoted their stance on quantitative tightening. Do you think the US is like the Fed will ultimately wait for something to blow up in the markets to pivot? What do you think will happen?
Well, let's before I answer that, let's dig into what went on in the UK, because this was a symptom of cheap money. So when you're a pension fund and you're holding precious money, you're holding the money of teachers, of firefighters, of healthcare workers, of a variety of different individuals, and you're holding their retirement nest. So when central banks artificially lower interest rates, it creates a search for yield, and that everyone searches for. But a pension fund, you would think, should be very conservative in their search for yield. But no. In the UK, they embarked on something called a liability-driven investment, LDI, which is where they levered up to, so they already owned gilts, but what they did is they borrowed money to buy even more gilts.
That's crazy.
Now. So what happened, what we saw the past couple of weeks with the very sharp decline in gilt prices and sharp rise in yields, is that a lot of these pension funds, again, playing with retirement money, got a lot of margin calls, collateral calls, and that's why we saw the spike in gilt yields. further exaggerate, and the Bank of England that essentially bailed out these overly aggressive pension funds. But again, I want to highlight that just as in 07, 08, it seemed like every week we were learning about some exotic product,
Right.
uh, like a CDO, for example. We learned this week what an LDI was. And I just wonder how many other acronyms out there that we're soon going to learn as the over-levered become exposed in a higher rate environment.
So you're saying this is just the beginning. The more we unravel, it's going to be. People are comparing what happened with Bank of England this week to Lehman. They were trying to avoid a Lehman situation. Do you believe that's what was happening?
Well, I guess in its own form, I mean, they were, like I said, they bailed out these pension funds. Imagine your pension fund getting liquidated because it didn't meet a margin call.
Wow.
Well, that really wasn't their job to take on margin, but central banks have created a very difficult environment for pension funds and insurance companies and a lot of endowments and a lot of different investment vehicles that couldn't take all the risk that the rest of us took in trying to meet liabilities, that they had to be conservative, but were forced to take this risk because they needed to meet a certain level of returns to address their liabilities.
Wow. Now, I seen an article recently this week that more than 40% of mortgages have been withdrawn in this week alone from the UK. How significant is this, Peter?
Well, I have to admit, I have to see the full details. I mean, the one thing, the characteristic of that separates the US from the UK in terms of the mortgage side is that in the US, the 30-year mortgage is very standard and conventional. Now,
Right.
obviously, you can do different denominations of a mortgage, but the 30-year mortgage is very rare outside the US, particularly in the UK, where a lot of mortgages adjust every couple of years. So those mortgages are much more sensitive to a jump in interest rates. So if your banks that that maybe have issued a mortgage or agreed to a mortgage 6 months ago because someone was closing on a house this fall,
Hmm.
well, obviously circumstances have changed. Your monthly payment looking out a couple of years could be much different. They may need to reassess. So that I think is partly due the reason why we've seen these mortgages get reined in.
So I've seen a lot of graphs as well this week. Is the Fed, they're hiking further and faster than any time in modern history. What do you make of this? Is this ultimately sustainable, or are they forcing a recession? What's your opinion?
So being a critic of this whole negative interest rate regime in terms of
Right.
on a real basis and let alone on a nominal basis overseas. So I'm okay with the destination of a 4% Fed funds rate, 4% ish. My problem at this point is the speed and velocity at which they're getting there. I mean, back in March, rates were zero.
Yeah,
So let's say they get
that
four,
wasn't that long ago either.
yeah, I mean, only 6 months ago, and then another 3 months they're gonna take it up to four and change, four and a half, four and whatever.
Yeah.
That is such a swift move that I'm worried. Again, I'm not worried about the destination. I'm worried about the path at which we're getting there is such a jolt and shock to the system that they're creating a lot of damage. I mean, we know in the markets things don't go up in a straight line. They don't go down in a straight line.
Right.
You can have a rally, and then you consolidate, and you see what's going on. You see whether okay is the cause for the rally a good quarter? Well, we're going to have another good quarter. Is it sustainable? But you consolidate first before another move. And
Hmm.
same thing on the downside. The Fed is just when it comes to easing, boom, right to zero, QE, bam. And now on the tightening side, they're just going boom in a straight line upwards without appreciating the lagged impact of what they're doing. Now, there's an immediate impact on the housing market and autos, which is interest rate sensitive parts of the economy. There should be a direct and quick impact. But the broader impact takes time, and they're not really giving the economy a chance to breathe
Right.
with this. So that's the problem I have at this point.
So you believe ultimately they're moving too quick and they're making a mistake.
Again, making a mistake at which the speed at which they're raising interest rates,
Right.
not necessarily a mistake in where they eventually want to take rates.
Right, right. That makes total sense. So another article I read this week, which will make a lot of people laugh, is Janet Yellen came out this week saying the markets are functioning well and everything is basically perfect. What do you make of this, Peter?
So this is the same Janet Yellen that didn't see the housing bubble. With Bernanke, everything was contained. They didn't see their policies that created the excesses. Search for yield. We see this. We keep watching the same movie over and over again.
Right.
Search for yield, which creates too much risk taking. And then was it 2020 when she said, "I don't think we'll see another financial crisis in my lifetime."
Yeah, that was the cherry on the cake.
So it's best to avoid listening to her opinions. Now we can listen to them. I guess it's best to avoid adhering to them
Hmm.
and following them.
Yeah, just inverse everything she says.
Just take everything she says with a grain of salt. She's probably a nice person. She has good education, but in terms of real world experience,
Right.
she doesn't have any.
Now, with all the chaos in the world, where's Peter personally putting his money? Are you investing in silver, gold? Where are you finding a safe haven in?
So for myself and our clients, it's obviously been a difficult year.
Hmm.
What I like to say in a bear market is those that win are losing less. Obviously, we're not a hedge fund, net short, but I have been bullish on commodities. We've been long energy stocks, which have done well this year. We are long gold and silver. I remain bullish, but they have, of course, been disappointing.
Hmm.
But gold down about 8% this year has certainly done much better than most stocks. So that gets to the lose less category.
Hmm.
I still think that there's a large bull run to go in the metals as the Fed tightens us into a recession and then is forced to reverse themselves. I think a big question, of course, is where the dollar goes as part of that calculus. And I think we're reaching an inflection point with the dollar in the sense of a lot of other central banks that are getting ever more aggressive in terms of their hiking. I think the Bank of England move is telling people that these central banks, getting back to the trapped analogy, that they are trapped,
Hmm.
and that the Bank of England, literally days before they were about to start selling gilts, aka QT, that they're then buying it, and then in the same press release saying, "Yeah, in a month we'll start selling them again."
Wow.
I think that gold had a nice rally that day, and that rally has continued. And I think maybe if faith is beginning to crack and people are realizing the impossible corner that central banks are in, that they can't extrapolate or they cannot extract themselves from their policies, then
Hmm.
silver are going to be a big beneficiary of that.
Well said. Well, Peter, we truly appreciate you coming to Wall Street Silver. We always genuinely appreciate you having coming on. So thanks you so much.
Thanks. I appreciate you having me on.
Awesome. Take care, everyone.